On this week's Emily Now episode, we're going to be talking about mortgage insurance for apartment buildings. I'm going to walk you through an example of a business owner that ended up buying another property for his business and waived conditions without financing. We're going to talk about, as a business, how much down payment do you need in order to buy a property, and we're going to continue our conversation from last week about mortgage insurance. As there's some interesting commentary that's floated around the news, which we think is important. So stay tuned. My name is Gallagher, founder of mlenow.ca. Each week we put these Emily Now episodes together to help you understand a little bit more about mortgages and loans. I've worked for the past 18 years with individuals, businesses, families who are looking for financing on their homes, for their business, the Emily Now platform that we built and have made available to the public is meant to help you understand your options. And so these episodes are meant to help you understand some of the background in those options. So if you want to know what a mortgage is or you have questions, you can tune in weekly where we answer some of the popular questions that come along. We talk about real-life examples of people that are looking for financing and some of the pitfalls and challenges that they've had to face so that you can learn from them and hopefully avoid them. And you can follow us on Twitter at Emily Now Canada. You can like us on Facebook. You can subscribe on YouTube. You can +1 us at Google. Find a way to connect with us. We're always posting interesting content, all related to mortgages and loans and helping you do more, because we believe that if we can help you do more, that probably will result in you having extra money. With that extra money, hopefully you'll be able to save for the future, maybe make some investments into things that will help you make more money, or if you had excess money, you might just be able to give it away to the community around you and see it have some social impact. So that's what we're here for. We're here to help you do more. mlenow.ca is a platform where you can learn how to borrow money, do it well, learn what your options are without having to talk to a broker or a banker first. You can get prepared, which you'll learn in this episode is very, very important before going to get financing. So let's get started with today's first question. Is mortgage insurance available for apartments? The answer is yes. If you're purchasing real estate, a building or a piece of property that has more than 5 units in it, you can get mortgage insurance for that property with as little as 15% as a down payment. The mortgage can be amortized over 25 years. In some cases you can get it to 40 years, but your premium will increase. The insurance premium is based on the amount that you borrow, and the range of premiums can be anywhere from 1.75% all the way to 4.5% of the mortgage amount. It's important to note, and we get lots of requests like this incidentally that come through mlenow.ca. People say, look, I'm buying a mixed-use building, so there's retail on the main floor, and then there's 2 stories of residential units above. Can I get insurance for that, or can I purchase this property with a little down payment? The answer is yes, subject to the residential floor area of the property being more than 80%. So in the example where you have a mixed-use building, you have retail on the main floor and maybe 2 floors of residential. As long as when you add up the square footage of the residential units, that it is more than 80% of the square footage of the whole building. Some of the basic criteria is that you have to make sure that for every $1 of debt that there is in terms of a mortgage payment, you've got to have at least $1.10 or $1.15 of net income. You're going to have 25% of the mortgage amount in net worth, with a minimum net worth of $100,000. So if you're going to borrow $1 million because you're going to buy a really nice apartment building and hold it for investment purposes, you're going to have at least $250,000 of net worth in order to meet the basic criteria. As a side note, because we're socially conscious around here, as are many people these days, and believe it or not, so are the insurance companies. If you end up purchasing a multi-family or a multi-unit apartment building or piece of real estate that qualifies under the energy efficiency guidelines, that you might be able to save up to 10% of the premium that you end up paying. So here's some things that you really need to know, and we talk about this quite often with folks that come through mlenow.ca. They're looking for a mortgage on a multi-unit building, and one of the gaps that exists in the marketplace is when somebody sells a property, they usually base the sale price on what the current rental rates are that a building is getting. And so here in Calgary, for example, rents have continued to go up, and there's a very low vacancy rate. So in the last little bit of time here, we've seen rents be very, very strong. So what happens is you get folks that own these apartment buildings, they put them on the market to sell them, but they base the purchase price on what the rent is that is currently being received based on the local market. The challenge becomes that on an appraised basis, when the bank goes to say, okay, well, let's see how much this is worth. We know you're going to pay $2 million for this property, but is it in fact worth $2 million? Well, what they do is they'll take the rent, but they have their own calculation that they use, and that calculation is usually based on sort of a national database of rental rates. They're based on averages. So what that means is if an apartment building is generating maybe $1,000 a unit, the vendor might say, well, no, but I'm getting $1,800 a unit right now, and so my property should be worth more, and that's why I'm selling it to you at this higher price. But the bank comes along and says, well, in order for us to finance the building, we're actually going to value it lower, because if we average out the rents over time, it's not $1,800 a unit, it's closer to $1,000 a unit. So what does that mean to you? Well, if you're buying one of these apartment buildings that has been priced at the high end of the value because of where rental rates are, that you may have to come up with the difference. And so if you're if you're purchasing a property that's $2 million, if the bank comes back and says, we think it's only worth $1.7 million, we'll lend you 85% of $1.7 million, well, you're going to have to come up with an additional $300,000 over what you originally hoped to put down, because the vendor, the person selling that building, they're not going to want to sell it at that lower price. So there's lots of resources on the internet. You can jump on our social media channels and get a download to the CMHC multifamily guide, and so we'll post that after this episode so that you can do it. You can read these things for yourself, but just the big takeaway should be, yep, you can get insurance on apartment buildings or mixed-use properties that have a residential component. You can do it with as little as 15% down. You need to make sure that the price you're paying will check out with the appraised value that's going to be used. Our second question today is, can I buy a commercial property with less than 35% down? If you're out in the marketplace, or you've been out in the marketplace looking for commercial mortgages for any period of time, you probably hear all the time, well, you need 35% down, how much can I buy this building for? You need 35% down, and 35% is kind of the number that you hear from bankers, brokers, mortgage specialists, consultants, whoever you might be using. The reality is that if you own a business and you're looking to purchase a commercial property, you can do it with less than 35% down. So if you have 5% or 10% or 20%, you may be able to purchase a property. In fact, we were recently part of a transaction where the business was able to borrow $8 million without having anything down. Nothing, no cash, zero. Very strong business, big earnings, lots of cash flow that moves through the business, and the bank they wanted to build their own facility. They'd been renting for quite a number of years, and they wanted to go build their own facility, give them some more flexibility. And so the bank lent them $8 million to buy the land, build the building, and they had to put no cash in whatsoever. Small businesses or private enterprises who are looking for less than $8 million, they can easily access up to 85% of the property value with a mortgage. So with as little as 15% down in cash, a business could go and buy a commercial property and find that it's probably not that tough. Banks will look at the overall financial stability of a business, and as an example, in one case that we saw come through mlenow.ca, where a business had requested our help, it turns out that they had they're in a little town in rural Alberta. They had an acreage that they had a TD Bank mortgage on, and they were renting a series of bays that they were operating their business out of. And so we went to TD Bank, and TD Bank says, well, tell you what, we already have a mortgage on their residence, so why don't we expand that mortgage a little bit? We'll give them a little bit more money on their house, that basically 15%, and then we'll fully finance the bays that they're looking to now buy from the landlord that they've been renting from. So in this particular case, a private enterprise was able to borrow about $800,000, but they didn't have to take any cash out of their business in order to do it. And that's a big deal, because most private enterprises, medium-sized businesses, live and die by cash flow. So when you say, oh, to come up with 10% or 15% or 20%, that can actually be really, really tough. And even if the business could come up with that cash, it leaves a hole in their cash flow, which can be very problematic. So banks know that, they're sensitive to that. And as long as you've put a good package together, you've run your math, you understand what your business can afford, you're prepared, you'll see that the banks actually have quite a bit of flexibility in what they can do for you on helping you get a mortgage for a commercial property. Because cash flow is key, one of the things that you definitely need to know is that if your mortgage payment is, say, $5,500 a month, if you go through and you do all of the calculations, the monthly mortgage payment would be $5,500 a month. The bank is going to want to see that the business generates at least $82,000 or $83,000 a year in net income. And then they're going to want to see that averaged over a couple of years. So here's what you need to know. If you're looking for a mortgage for a commercial property for your business, and you don't have 35% to put down, make sure that you've run the math and averaged it out. It happens quite frequently where a business will send their request in at mlenow.ca. They will say, oh, we're having a great year, we think we can afford this amount of money based on our current financial statements, and this is great, can you help us? But because the banks are going to average the net income over a few years, it might be a case where the business, even though they're having a good year this year, maybe last year wasn't so good, or not as good as this year or the year before. And so when the bank now goes to average out the payments, the bank will say, well, you know what, you actually can't afford the amount you thought you could. We can still approve you, but it's going to be at a lower amount. So make sure that you're prepared. Make sure that you know that you can afford what it is you're going to make an offer on. And buying a commercial property is way more affordable than you might think it is. Certainly if you have a lease payment right now, and because of low interest rates, you could consider converting that lease payment into a monthly mortgage payment. And you may not need as much cash as you think you do. But if you want to get started, go to mlenow.ca, that's mlenow.ca, and run some numbers. It doesn't cost you anything to use it, and you can see what the interest rate range is going to be. You can see how much cash you might need. You can see what the average income is that you're going to need, and so we'd encourage you to do that. But can you purchase a commercial property with less than 35% down? The answer is yes. Here's a great example that again follows along an example that we talked about last week, except this is a case where a business owner who currently has 2 real estate properties, they gross over $20 million a year in annual revenue, so very good business. They've not only survived the downturn, but with the current economic environment, they've been able to continue to do very well. And so the entrepreneur who owns this business decided to make an offer on a 3rd property that is complementary to their existing business for many reasons. And not only did he make the offer, put the down payment in place, he waived conditions, but didn't arrange for his financing. And so there's a bit of some repetition here. If you've watched some of these Emily Now episodes, you'll realize that people waiving conditions or committing to real estate transactions without actually knowing how they're going to finance it is kind of a theme that is always hanging around because it happens all the time. Closing is a few weeks out, so he's come through mlenow.ca to ask for some help. We're going to use private financing to close on the transaction, and then once we've closed on the transaction, then we're going to take a few months and work with a traditional bank to refinance not only this property but maybe some of the other two properties that this business owns as well. So the question is, why does this happen? Dylan, if you're telling us that this is a theme that we continue to talk about in some of these Emily Now episodes, why does this happen? Why do people commit to real estate transactions or any transaction without financing? And I think it's, in the case of an entrepreneur, part of their charm is that they'll look to act first and think later. But all jokes aside, many businesses simply don't know what's required to be approved. Imagine if you're an entrepreneur, you're running a business that grosses $20 million a year, maybe nets $2 to $3 million a year. You'd think life is pretty good. You maybe don't know where all of the dollars are, all of the dimes and nickels, but you're doing well. And so as you're operating your business each day, you see opportunities and you want to take advantage of them. And so you pull the trigger, you act first, and then you figure, the people that you have working for you, or the people in your center of influence, like your accounting firm or your bookkeepers or your advisors, that they'll just sort of figure out how to make it happen. But the cost of not being prepared, as I think many business owners simply they're just not prepared. I think it's hard to be prepared. I think it's hard to know where to get the information to be prepared. Of course, mlenow.ca is one of those places. But the cost of not being prepared is significant. So in this example, not only is the borrower going to pay probably maybe 3 to 4% in fees to get the financing, because he's borrowing it at the last possible moment he can borrow it, but he's also going to end up paying interest only in the double digits. So huge cost of capital, and then he's going to have to go through this whole exercise again once we go to the bank and we refinance these mortgages for him. So why would a business agree to do this? What's the rationale that a business has? Well, I can't speak to every business owner out there, but in this particular case, there's a few things. The property is being purchased, but it's being done so below market values. In fact, it turns out that this particular property is a court-ordered sale. So it's significantly below market value. It has to close quickly in order for the borrower to close on it and get that price. The property is adjacent to an existing property. It complements the business and will allow this business now to improve their operations because now they've got more floor space. It'll give them a whole new angle on how they can service their customers, which they didn't have before. And the property offers a few other leverage points for the business. So the real value in terms of what this particular property means to the business is far more than whatever the cost of financing is. Now that's not to say that with a little bit of planning that the business owner couldn't have been in a better position. Maybe if they had worked through mlenow.ca as an example, they would have known the income, they would have known the paperwork they would have had to put together, so when they made the offer, they probably would have had enough time to get it done at the bank. But because they're not really prepared, they don't have everything they need in order, they're going to have to use private financing, close on the purchase, and then after the purchase start working with a bank to take that money out. So if you find yourself in that position, much like this particular business owner, make sure you figure out or get your hands around what you think you're going to need to have in place in order to get financing. And it doesn't really matter whether you're buying out a shareholder, buying a competitor, refinancing your balance sheet, buying a commercial property. You need to be prepared. At mlenow.ca we have a score, and that score will help you in a very quick, easy way understand what you look like and what the banks that will fund you look like based on a score. And it's pretty simple. So that's one way to do it. Another way to do it, of course, is to visit with your accounting firm and make sure that you've talked to them and said, look, I think I might need to borrow some money in the coming year. What do I need to know? What do I need to have together? And what can you help me with? So make sure that you're prepared. This week we're going to continue our conversation with the CMHC mortgage news that's sort of floating around the marketplace as it seems to continue to be hanging around in the headlines. Most recently this week, the Organization for Economic Cooperation and Development, or OECD, had made some recommendations to the Canadian government that they might want to consider transferring the risk from their CMHC portfolio from the government's hands down to the private sector. If you'll recall from last week, I had suggested that I thought that was going to happen anyway. I think that that we're going to see CMHC sort of leave the market. They might reemerge as a private company, but this week the news was that the OECD suggested that they actually transfer that risk down to the private sector and reduce the portfolio from what is currently $600 billion. So that's how much insurance the government, or that's how much the government has insured for residential real estate, $600 billion. And the OECD said you should reduce it down to $300 billion as sort of a first step in the right direction. I mean, I've talked about this previously. I've got some pretty strong opinions about it. I think that the government will transfer the risk to the private sector. If you look at how Canada's government, if you look at how our government has performed over the last few years, certainly during the economic downturn, the policies have been very prudent. I think we've made really great decisions, or I think the government's made really great decisions with how they've had to handle the financial markets, and I think that they're very much aware of the risk that CMHC carries for them. And if you believe any portion of the hype right now, which would say that Canada's in a bit of a housing bubble, that today is probably the best day for the government to start weaning itself off of CMHC into figuring out how they can move that entire portfolio down to the private sector. Because the market is strong, obviously it's a good time to do this, but so what? What's the big deal with CMHC anyway? Why do we keep hearing it in the news, and why are we talking about it? Well, I believe, I don't know that this is shared across the marketplace, but I believe that our Canadian real estate market has been propped up by the deep pockets of CMHC. When you think of what $600 billion does to a marketplace, the next two insurers in the market don't even come close to CMHC. I mean, CMHC doesn't just own the majority of the market. I mean, they basically own the market. So if you've bought a home in the last couple of decades and you've done so without having at least 20% as a down payment, you probably have CMHC insurance on your home or have had it on your home at some point. So because the access to insurance has been fairly easy, because it's been plentiful, I mean, $600 billion for a small country, or for a country like Canada that has a small population, that's pretty amazing, and that's forced a lot of real estate activity. That's created jobs. I mean, it's had great economic impact, but my thoughts are that I think it's propped up the market, and I believe that more involvement from the private sector will actually change the face of our real estate market. For those of you that don't know, mortgage insurance protects the bank against a loss when you stop making your mortgage payments. With CMHC, they actually offer a bit more protection for a bank than the other two insurers do. And so if CMHC were to leave the marketplace or find a way to dwindle its market share and give it to the private insurers, I think that we would see some adjustments in approval criteria. I think that it would, because private insurers don't have unlimited funds, they don't have deep pockets, as it were, I think that that would kind of change the pricing. I think banks would come up with different policies. I think we'd see quite a bit of change happening. I don't think we'd see it right away because Canada isn't, I mean, a runaway economy, and we don't have a gazillion people that live here, so it's somewhat contained. But I think that now is probably the best time, if there was a time, to start figuring out how to de-risk the CMHC portfolio, give it to private enterprise. Other markets have demonstrated that the private companies do create a different feel in the marketplace, a different set of parameters and variables that people have to operate by. They're more competitive, there's more efficiencies, and then there's also different value adds that come along with it. So what does this mean for you? Well, if you currently have a home with CMHC insurance, it probably doesn't mean anything to you right now, but in the coming years, I think it could mean an adjustment to prices of homes. And I'm not talking about 2% or 1% or a little blip on the chart. I actually think it could be a pretty significant impact to real estate prices across the board. And that probably would impact you. Not today, but over the coming years it would. If you're looking to purchase a home in the coming years, it's good to know what's happening with insurance, because if you don't have 20% or more to put down, chances are you're going to need insurance. And if the rules change or the criteria change or the cost of insurance changes, you're probably going to want to know that and start thinking about it in your planning. I think that there will probably be new insurance companies coming to the Canadian market if CMHC were to start giving up its market share. I think that at the end of the day, borrowers always need to know what their options are, whether new insurers come to the market, whether CMHC downsizes or what have you. And mortgage insurance is one of those variables that you kind of need to understand a little bit, or a lot, as it were. And at mlenow.ca, it's a perfect place for you to discover that. At mlenow.ca, you can see not only what the insurance premiums are going to be, but overall you're going to be able to see your down payment, your monthly payments, how much income you need, what the documents are, kind of the questions that banks or brokers or mortgage specialists are going to ask you. And so you should definitely check that out. And so we thank you for watching this Emily Now episode. Hopefully you've found it valuable. We talked a little bit about mortgage insurance for apartment buildings. We walked through an example of a business owner who at the 11th hour has to use private financing to close on a piece of land, and why he did that. And now we've just finished chatting and bringing you up to date on this continued dialogue in the news about CMHC and the housing bubble, and how the government needs to start planning to get rid of the portfolio. So we'll catch you next time, and in the meantime, visit mlenow.ca to learn about what your options are and to get prepared to be approved for your next mortgage or loan.